Hi there, it's Ben Binger here, your local home loan expert. And on this episode of Did You Know, we're going to dissect how the mortgage market works, what influences interest rates, and how have we come into the system of lending that is used today in the U.S. Now, before we look at how the mortgage market works, we actually need to unpack and understand why we have a mortgage market to begin with. Why we have the mortgage market is based on the risk of what might happen in the stocks and bonds markets in the future. You see, home loans are bought, sold, and often traded on the bonds market just like other investments. We'll get into that in a bit, but for now, know that many other countries don't even offer the same kind of loan programs available in the U.S. You see, without a mortgage market, many other countries simply can't guarantee a stable, fixed-rate mortgage. You see this in countries that don't have a system like we do. Their only mortgage options are set up on a high down payment, adjustable rate system. Here in the U.S., as a borrower on a 30-year fixed-rate loan, you are guaranteed 30 years at the same interest rate. But how do banks do this? Can they predict what interest rates will be like in 30 years? No. This is why we have a mortgage market. The mortgage market system is really built off the idea of minimizing risk to both you as a potential mortgage borrower and the investors ultimately taking the risk to buy the mortgages. What might surprise you is who the ultimate investor of mortgages is. Well, we'll take a look at that in a bit, but for right now, let's look at this journey of what a mortgage loan takes. You're a buyer and you need to borrow money for a home purchase, so you go to your local favorite lender and meet with a loan consultant. That loan consultant works for a mortgage company to close and fund your loan. Now, while some lenders do service their loans, there are many that don't want to hold on to this loan, so they sell it to another investor or loan servicer. If you've ever gotten that letter in the mail that your loan has been sold, this is what's taking place. Now, the investor purchases the loan and they become the loan servicer. For more on this topic of loan servicing, don't forget to check out my episode on the importance of who services your loan. That investor or loan servicer then sends your loan together with millions of others bundled or packaged up in what are called coupons to Fannie Mae and Freddie Mac, the government-sponsored enterprises you perhaps heard about mentioned in news cycles. But what do Fannie and Freddie do? They package these loans and they put them into larger pools or packages and sell them. They realize interest rates are always moving, so they'll typically bundle loans in 30-day or 60-day bundles, which is why when you lock your interest rate, it always locks for a specific window of time, often to coordinate with selling to one of those 30-day or 60-day bundles. Now, Fannie and Freddie then sell these mortgages to Wall Street. Wall Street underwrites them and sells them as mortgage-backed securities on the open bonds market. You still with me? Since most people pay their mortgage on time, every time, mortgages have one of the most stable historic investment records. They don't yield a high return, but they also don't pose a high risk. So they are perfect investments for people looking to find a low risk, low yield place to put their money into. Financial planners and money managers see the value here for retirement investments and often will add these mortgage securities into mutual funds and 401ks. Now, who puts their money into these different retirement funds containing mortgages? Who is the ultimate investor that wants to have protection and a bit of a safety net for their money as they put it into retirement funds? You and I. Take a look at your mutual fund, your retirement plan, or your 401k, and you'll see that they're loaded with Fannie Mae and Freddie Mac funds. This is the interesting irony, is while we can certainly look back to just within the last decade and see the shortcomings of a system like this, ultimately our mortgage market here in the U.S. is set up to provide investing protections, a place where you and I can put our hard-earned dollars into a future retirement plan. The life cycle of a mortgage really is a pretty crazy deal, isn't it? And now you know. Thanks so much for watching. Comment, like, don't forget to subscribe. We'll see you next time.